What if everything changed overnight just because a war started thousands of miles away? Imagine waking up one morning and suddenly gasoline prices have skyrocketed across the world. It may sound surprising, but this is exactly how powerful the global oil market is. Wars can shake economies, affect daily life, and make oil prices jump in hours. It powers transportation, fuels industries, and supports global trade. Because of this, any disruption in oil supply immediately affects economies around the world. Whenever a war begins, investors and traders start asking one important question: will oil supply be disrupted? If there is even a small possibility that oil production or transportation might be affected, the market reacts instantly. Prices can rise within hours because traders fear shortages in the future. However, predicting exactly how oil prices will react is extremely difficult. Sometimes wars cause prices to surge dramatically, while other times the market stabilizes quickly. This uncertainty exists because the oil market is influenced by many different factors such as global demand, political decisions, production levels, and international trade route. To understand this relationship better, we need to look at some historical events that clearly show how wars can change oil prices around the world. One of the most famous examples in history is the 1973 oil crisis. This crisis began during the Yom Kippur War when several Arab oil-producing countries decided to place an oil embargo on nations that supported Israel, including the United States. Suddenly, a large portion of the global oil supply was restricted. The impact was immediate and dramatic. Oil prices increased nearly 4 times within just a few months. Many countries experienced severe fuel shortages, and long lines appeared at gas stations. This crisis affected the global economy deeply and caused inflation and economic slowdown in many nations. Another important example happened during the Gulf War in 1990 when Iraq invaded Kuwait. Both countries were major oil producers, and the world feared that a large amount of oil supply could disappear from global markets. As soon as the conflict started, oil prices jumped sharply because traders expected a major shortage. However, when international forces intervened and oil production resumed, the market eventually stabilized. These events show that sometimes the fear of supply disruption can affect prices even before the actual supply is reduced. A more recent example is the Russia-Ukraine conflict in 2022. Russia is one of the largest energy exporters in the world. When the war began, global markets immediately reacted. Many countries imposed sanctions on Russian energy exports, which created fears that millions of barrels of oil could disappear from global supply. As a result, oil prices surged to some of the highest levels in years, increasing fuel costs and inflation across many economies. These examples show that wars create uncertainty in energy markets. And whenever uncertainty increases, oil prices become more volatile around the world. If you found this explanation helpful and want to learn more about global economics and energy markets, share your thoughts in the comments and subscribe for more insights.